Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and is it bubble and trouble, or are we just selling newspapers? Housing, it's the subject that everyone talks about. We like the equity market, but housing, how will it affect us and how will it affect the equity market? Today, I'm joined by Ben McGarry from Totus and Rhett Kessler from Pengana. Rhett, I'll start with you. Housing, are we in a bubble?
Well, prices are really high, but it's always been high in Sydney and where there's been scarce supply. I think they're okay. I think it's a muddle through.
Okay, Ben, do you agree on that broad question before we get into some details?
Yeah, I think Rhett's not far off, but I do think there are parts of the market, Brisbane apartments and some parts of Western Sydney, that are definitely stretched.
Okay, let's go down the bad case scenario. House prices are way overshot. We're in for a 20% fall. How does that affect us in the equity market, do you think?
Look, I think it could have big implications. A lot of Aussie businesses have benefited from strong East Coast housing. It would certainly be a hit to our banks, the retail sector. I think that could be a catalyst for a reasonable fall in the stock market.
Right. Rhett, do you agree if we went down that scenario?
I think so, yeah. I think there's a lot of people who are caught in that very difficult place where they're relying on drawing down on their mortgages, and that's becoming increasingly available because of house prices going up. And if it turns, they could find themselves in a world of pain.
And a lot of the investors, especially the overseas guys, investors, have picked on our banks. Our banks are overpriced, they're too exposed to the housing industry. How do you see that? It's a big part of our index.
It is a big part of our index. We've got about 15% of our money in banks, which is quite big for us.
Yep.
I think they're quite solid businesses. They've got pricing power, and the sharp uplift in house prices has certainly underpinned their loan to valuation ratios. So I think they're okay and they're managing all right. There's probably a headwind coming, but we think they're cheap.
And what about those banks? You mentioned them before, Ben. They're the big part of the portfolio. Obviously, there's property companies, there's retail, but banks are really under the pump. Bad debts go up, house prices are down. Paint us the scenario.
Yeah, well, we're long banks at the moment under that muddle through scenario, but we'd definitely be sellers in a large price correction environment. I think in the current situation, the banks' news has stopped getting any worse, and I think they're a good, reasonable bet. But yeah, we'd definitely be sellers, and of particularly Bendigo in a sharp house price deceleration.
Bendigo Bank? Okay, let's go back to the macro. So can the Australian equity market continue to rise if we did have a fallout, like the one we've just kind of described?
I think it'd be very difficult. I think the resources space has had a good run over the last 12 months. I just think there's so many parts of the market that are subject to housing. As Rhett said, people have been using housing as a bit of an ATM or savings buffer. I think equities would really struggle.
Okay, Rhett, do you agree with that? If the housing market did hit the skids, it was bad. I mean, we had UBS, the broking firm, come out and said we're at the peak. Can the equity market keep just trucking along regardless?
3 points. First of all, house prices, the way they're going up, I think elastic band stretching. At some stage, it's got to snap back. The real thing we're trying to understand is what would cause it to snap back. So if it's unemployment, I think everything will get hurt. And secondly, remember that long duration assets go down when the cost of money goes up, and we've had the reverse for some time. So if interest rates go up sharply, that will definitely affect everything, not just houses, but the whole equity market, which are obviously long duration assets.
Okay, Ben, so how do we get around that?
Look, at the moment we've got 25% of our portfolio in US stocks. I'd be increasing that weighting under a sharp house price fall scenario in Australia. We would be avoiding highly cyclical retail stocks, the likes of JB Hi-Fi, Harvey Norman spring to mind.
Yep.
And yeah, don't be afraid of. Yeah, I think cash would be a great thing to hold in that kind of environment.
But if you can't wander off overseas, park your money over there, how do you get around a bad housing market if you're an equity investor?
Yeah, we like to buy what I call toilet paper and toothpaste type businesses. So those are businesses where every day people get up and they have to buy things to experience their daily life. So, you know, if they're going to turn the gas on, absolutely. Are they going to have to undergo medical treatment? Absolutely. Those are the kind of things we buy.
All right, let's go to the other scenario before we finish up. House prices up another 19% in Sydney over the next 12 months, up 15% in Melbourne. Can you see that happening, and what does that mean?
I can't see it happening. Absolutely not. I think that they'll be flat at best.
Okay. Ben, we're up a lot more. People are a lot wealthier. Good for retail stocks, good for banks.
Yeah, market will be higher if that's the case. I agree with Rhett. I can't see it happening, which probably means there's half a chance it does. Look, a strong housing market, it would be the flip case of what we talked about. Quite good for equities, good for retail, market up.
So your house, it's a place to live. It's not somewhere where we print money. Don't sit like this.
All right, get in your face.
One, because I've probably got bad breath, and two, it looks weird.
It's going to freak everyone out. Yeah, fair enough.